Welcome to Finance 300. This is your online instructor, Diana Block, and we are going into week 5, I'm sorry, going into week 5. It's flying by. And this week we're going to talk about bonds. So we're going to have a little bit of discussion about bonds and some examples as well. So bonds are a loan to a company or a municipality. You can have county bonds, city bonds that are paying for some upgrades or road work in your city, or you can have corporate bonds, which we're talking about in this class, where you are actually loaning money as the investor. You're loaning money to that corporation, and the company has to pay you back the principal, and also they have to pay you back interest. So some of the bond terminology that we want to look at is the term. The term is the amount of time from now until the principal is returned. So for example, if a 25-year bond was issued 15 years ago, you've got 10 years left until they have to pay you back your principal. So you've got a 10-year term remaining on that bond. And then the face value or the par value, you may hear either one of those terms, and that's the amount of principal that's going to be returned to you. So generally, for all our examples here in class, and most of the time in general practice, you're going to be talking about a $1,000 face value bond. That's going to be like your standard amount. That's how much principal the company, the corporation will have to pay you back at the end of the bond term. Now, just a note, that isn't necessarily the amount that you paid for the bond, and we're going to talk about that later, but that is the amount they're going to pay you back, the face value. And then the coupon rate is the interest rate that's being paid on the principal. So if you have a 10% coupon, that means the 10% of the face value is the interest that the corporation has to pay you every year of the bond term until they pay you back the principal at the end. So the coupon rate is a percentage of the face value. Generally, the coupon payments are going to be made twice a year, so we're going to assume that it's an every 6-month payment. So if you have a 10% face value, 10% coupon payment, what you're going to get is 5% every 6 months. Unless we specify something different, that's the assumption we're going to make. So let's look at how do we use our calculators that we used last week in our homework. How do we apply that, our Excel calculations, to the price of a bond? We're going to talk about that. Some of the main calculations that we would do with a bond is to get the price of the bond. And we can actually use the present value function in Excel that we practiced and learned last week to determine the price of a bond. Then another common calculation of a bond is the current yield. And the current yield is the annual interest divided by the current price of the bond. So the annual interest, we're talking about that coupon payment, divided by the current price of that bond will give us a current yield. Let's go ahead and look at some example calculations at this point. So I've got some examples ready here. And with these example problems, well, this example problem, this first one here, we're going to get the price of a bond. And there's two cash flows that you get from a bond. You get the principal that you're going to be paid back at the end of the bond term. You also get coupon payments twice a year. So those are two different cash flows you get from a bond. And the price of the bond is the present value of all the future cash flows. So let's see how we calculate that. First, we'll get the present value of the principal, the $1,000 that we're going to get at the end of the 10-year term. What is the present value of that? So we can use the present value function that we learned last week, and we're going to enter the market rate here and divide it by 2 because bond payments are made twice a year. So we're going to have 2 compounding periods per year. And so the number of periods is 10 times 2. 10 years times 2 payments a year. And then the future value that we're going to receive from the bond is $1,000. So we've got the market rate divided by 2, the number of periods multiplied by 2, and the future value. And that tells us that the present value of that $1,000 we're going to get at the end of the bond term is $376. Now, we also need to get the present value of the coupon payments. So let's grab the present value function again. And we're going to enter again our market rate divided by 2, our number of periods times 2, and then we're going to enter the payment. Now it's an 8% coupon payment, which means 80% of $1,000, and so that's $80, but again, we're assuming that we're going to receive these payments twice a year, so what we're actually going to get is $40 twice a year. So we enter that information, and we find out that the present value of the coupon payments is $498. So if we add those two together, the present value of the principal, the present value of the coupon, we find that the present value of the bond is $875.38. That is the price of the bond based on this information. Now, this other example, we're going to look for the yield. In this situation, we know what the current price is. The bond is currently selling for $718. It's a $1,000 face value bond that gets an 8% coupon, and there's 16 years left in the term. What we don't know is the yield. So we can figure that out using our rate function, R-A-T-E. We learned that last week as well. So if we take the rate function, and we enter the number of periods that we have remaining in the bond, and we're going to multiply that times 2 because we're assuming that the bond is going to pay its coupon payments twice a year. Unless we're told differently, we're going to assume it's a twice a year payment. And that payment amount is $40. It's an 8% coupon, but we get it twice a year, so that's $40 twice a year. Now, the present value of the bond is the current price. I'm writing a negative $718 because that means we're going to pay $718 for the bond in order to receive $1,000 in the future. So the future value is $1,000. That's how much we're going to get back from this investment. And so we put in this information into Excel, into the rate function, and it tells us the yield is 6%. Now, we did this calculation based on twice a year, which means that we need to multiply this result times 2 to get the annual. So we've got a yield for annual that's 12% based on this information. If we pay $718 for it today, and we get 8% coupon payments for 16 more years, and then the principal back, that means we'll be getting 12% yield. So those are some examples of how you're going to use the present value functions that we learned last week to apply those to a bond to find out prices and yield on bonds. Okay, so let's go back here. And we will see some risks. Yeah, let me talk about some of the risks with bonds. Bonds are generally considered safer than stocks because of the fact that the company has to pay you back something. They owe you coupon payments, and they owe you money. So you're a creditor of the firm. However, keep in mind that that is contingent upon the fact that the firm is able to pay you those coupon payments back. Even though they have a contractual obligation, just like we have a personal contractual obligation to pay our bills. But if we don't have the money, then we may not pay it. The same thing may happen with a bond. You're owed this money, but there's some risk factors that could cause you not to receive it. So the bonds may sell less than their valuation because that firm maybe has some financial instability or they're a credit risk. Now, companies are rated for their bonds similar to the way credit scores are rate individuals' credit. So every company is not created equal when it comes to their ability to pay back bonds. So I'm going to show you this website. me get all this on here. This is from Bonds Online, but what I want to show you is the ratings for bonds. So you've got Moody's and S&P's are the two main bond rating services, and then also some people use Fitch. But what they do is each one of these firms has a different rating system to rate bonds. So we see under Moody's, the best bond rating is AAA. A AAA under Moody's means this company has a very strong capacity to meet its financial commitments. And that's the equivalent of a AAA at Fitch and S&P. So if we look down here at some of these B ratings, let's look here. This is a double B rating for S&P. This company's, if a company is rated double B, that means this company has some major ongoing uncertainties. And so they have an inadequate capacity to meet their financial commitment. So there's some additional risk here with that firm. Let's look at triple C under S&P right here. This company is currently vulnerable, very dependent upon favorable business. A default is more likely. If you get a D rating, this company's already failed to pay one or more of its financial obligations. So you're in serious risk here. So the calculations that we did for valuation are assuming that the company is actually able to make the coupon payments and actually able to make the principal payment at the end of the term. Based on that firm's credit rating, if they are a stronger financial risk, the bond could still sell for less than what we've calculated the price should be. So that is the risk that you want to keep in mind. So this was just a short introduction to bonds. I also want you to make sure that you review the PowerPoint slides that are included with this week. And there's some videos in the additional resource area, at least one video in the additional resource area that'll also walk you through some examples. There's some practice problems this week before you get to the actual assignment. I encourage you to work through all of that so that you're very familiar with how to do the calculations when you actually get to the assignment. I'm looking forward to talking with you again in the discussion board this week. And if you have any questions, make sure you just send me an email or catch up with me on Blackboard IM. Have a great week.